Buongiorno, bonjour, grüezi miteinander. Good afternoon, everybody. I'd like to welcome you to our today's webinar. My name is Michael Trübestein. I'm president of the RICS as well as head of the Master of Science Real Estate program at Lucerne University. So this year we declared the year to be the year of opportunities, and we've seen so far plenty of opportunities plopping up worldwide. And likely Asia will offer plenty of opportunities this year as well as in the upcoming years. And so I clearly like to invite you to probably the topic for today and for this year. So all about investments in Asia. And during the webinar, we really try to give you some important advice of how to manage real estate, how to invest in real estate, and how to do and derive your targeting investment strategies. Therefore, we split up the webinar in broad overview. We will have some ideas from the research side, as well as some ideas for investments in core, as well as opportunistic products. Hereby, I like to welcome more than 200 participants for clearly a very, very nice and hot topic. As always, please use the possibility to ask your questions in the chat. So we will answer all your questions at the end of the presentations during the guided discussions. And we would like to offer you the possibility to ask additional questions also to the speaker after the webinar. So you will receive all the presentations as well as all the contact details of the speakers in an email on Friday this week. So please feel free for you to contact all speakers for some additional ideas of how to invest and how to derive your targeting investment strategies. Like always, we will publish an article in our cooperation partner, the Journal of Immobilienbusiness. So you will also receive some additional ideas of investments in Asia in the media. And so you can clearly reread some of the essential outcomings and a summary of today's webinar in one of the next issues of the Immobilienbusiness. So why did we choose China today? Why did we choose Asia today? So Asia, as you know, offers plenty of possibilities. And to give you a short illustration of the importance of Asia, we just circled more than 50% of the world's population living in Asia. So within the circle, you have such a dominant power of demographic developments, of purchasing power, as well as of people going to the middle class and becoming richer and more interesting for real estate investments. Easily seen if you compare the slides, the middle class in Asia, is one of the most important to increase if you have a look around the world. And it offers plenty of possibilities for you to do investments and to find the right spot for Asian investments. Based on the middle class, we will see consumer spending, the possibility to acquire real estate, and also to give you the perfect investment opportunities. Further, if you have a deeper look at the macroeconomic side, we can see, and that we have seen also in the last years, a very steady growth, economic growth in Asia. If you compare it to Europe, to the growth in Europe as well as the growth in North America, we can see first of all a larger growth, so a higher amount of growth rate in Asian countries, as well as a steady growth. So either during some crisis, we can see we have a little growth. So it's definitely a clear way of thinking about targeting investments in Asia. Nevertheless, of course, you need to select the right partner as well as the right countries to do your investments. Nevertheless, and that's also true, we've seen some downturns in the market, but downturns in the market always offer a clear possibility for investments. So it takes opportunity to restructure your opportunities, to restructure your investments. On the first side, on the other side, besides taking the opportunities, think about the diversification, think about all the possibilities that are offered by Asian countries. And that's why we selected this graph also as our starting points. We will show you more or less the 101 for investments in Asia, for those who move to Asia for the first time, as well as for those who are already more experienced in Asian investments. So you will find both tracks during today's webinar. Coming up to some selected questions you already received during our emails. So we will look at different asset classes and different markets. We will show you some successful investment cases, also covering further opportunities and also highlighting more or less some challenges and the possibility of how to solve these challenges. We will go deeper into some macroeconomic figures in our research presentation, as well as the clear topic of how to do your investments and how to structure it. Finally, of course, like always, we will give you a clear guidance about how to do your investments and what are the lessons learned from past investments, from experienced investors, as well as, of course, based on this year's target to see where's opportunities and especially how can we evaluate Asian real estate markets, and up to you then how you can select the right way to do your investments in Asia. Like always, we selected the outstanding speakers for the different topics. They are all renowned and they really have a broad and deep knowledge about how to do the investments and how to highlight each different cases and how to highlight each strategy. So we'll start with Simon Tracy, who is CEO of private equity real estate at CapitaLand Investment. And hereby to all the speakers, a very nice evening to Singapore and one very nice good day to the person who is in Europe. So we'll have a broad overview. So hereby we will start with a short opening remark from Simon, then going on with some current trends and research about where to go for Asian Pacific markets, where to have a deeper dive, and what are the current outlooks from the research side, which will be done by Jujin. Then we will come in the next presentation to the value-add opportunities, which will be presented by Jeremy Choi, who will dive deeper into the topic of really where are the opportunities and how you can use your opportunistic value-add strategy for probably having a little bit of excess returns. In addition, we will also mirror the second part, so the core plus opportunities, for which will be offered by Asian markets. And Kevin Chi will dive deeper into the topic of where to dive or where to invest in core plus opportunities and which will be the targeting possibilities for European investors. Finally, we'll go over to the emerging opportunity in private credits by Arjun Pandit, who will also give us some ideas about these possibilities. Finally, we will go to emerging opportunities in service residences and co-living, which is a very interesting topic, especially for Swiss and European investors, which is very up-to-date in Asian markets and which will offer plenty of possibilities. So we will, besides looking at different markets, of course, looking as always in different concepts. And hereby, I like to welcome all the speakers for their presentations. As you see, we have plenty of interesting topics. That's why we will directly rush to the next presentation. And I clearly like to hand over now to Simon, who has a broad experience in Asian and US markets, also working a couple of years at BlackRock, being responsible for all US equities. So he does know the market. He's the expert about giving us a perfect overview and welcome speech. Simon, very nice welcome from my side.
Great, thank you, Michael. That was a really nice kind of opening, and congratulations on these ongoing, very informative webinars. A big hello to everybody. I understand most people are in Europe, so good afternoon, and a number of people I know, so a big hello to you also. Hopefully you'll find this very informative, and looking forward to the further discussions as you wish over the coming weeks. So a very quick overview on CapitaLand. As you can see, we're one of Asia's most diversified on-the-ground real estate investment managers. We have approximately 100 billion in assets under management around the world. And you can see about 90% of that is in the Asia Pacific. That's really our backyard. That's where we started 20 years ago when CapitaLand was formed. And today we have public and private management in terms of the REITs. So we're about 30% of the Singapore REIT market. That's 6 REITs, including 3 REITs, which are global. And therefore, that's how we have 4 billion in Europe and 5 billion in the US. We also have a number of private equity real estate vehicles up and down the risk return spectrum, discretionary, non-discretionary, country, sector, and regional funds, and also now some equity investments which are reaching into Europe and Asia. The benefit of the platform is that we really get to see what's going on globally, see what's happening in the public markets, and that helps inform us on the trends out there that we're seeing to become better investors. We're very much boots on the ground. We have over 10,000 people, and this includes 300 people in investment and fund management roles around Asia in one of our 18 offices. So we're in all the emerging and developed markets, including China, Vietnam, India. Each of those countries where we've actually been there for 30 years, and also Malaysia. And then the more developed markets, we have very deep presence, obviously, here in Singapore, Japan, South Korea, and Australia. And you can see here that the diversification across the different real estate sectors is very prevalent. And that, again, helps us understand what's happening in the markets. On the next slide, you'll see a bit more of a breakdown of the different verticals where we have capabilities in. So, of course, you will expect us to be in office and retail and logistics, but we've also developed our name in terms of integrated developments over the years. And also in the last 5 to 6 years, developed deep presence in the data center space in Europe and Asia Pacific, as well as in the private credit space, which again, we think is a very, very interesting sector. We've heard a lot about the US and the European private opportunity, but there is a very good sweet spot now in Asia as well, which Arjun will talk about a bit later. In terms of lodging, that's predominantly short and long-term stay service apartment. A little known fact about CapitaLand, we're the world's largest manager of service apartments in over 40 countries around the world, about 165,000 keys, central reservation systems, about 14 brands, which talk to different market segments. So that's a very interesting market sector that Ho Kit will talk about. I suppose in summary, before passing over to my colleagues, clearly Asia is at a very interesting point in the cycle. It's an area, a region where we see ongoing growth through to young populations, urbanization, huge infrastructure spend, very strong savings rates, and a market that has developed economically very strongly within the region itself, as opposed to purely being the world's exporter to the more developed and mature markets. Today, of course, in investments, when you talk about Asia, people think China. And I think Michael was a good example of that. Everyone wants to know what's happening in China. Again, we can talk about that in the Q&A time. It's clearly going through a super cycle, but the rest of Asia is somewhat impacted, but mainly from a supply logistics perspective, which also creates interesting opportunities in markets including Vietnam and India. So with that, let me pass on to my colleague Eugene Au, and he'll give us an overview into the research overview. Thank you.
Good afternoon, everyone. So let me start with the macro backdrop. And I think for one, geopolitics and monetary policies are and will remain the headlines in the global landscape. 2024 is also going to be a year of elections with more than half the world's population going to vote, including the EU and India mid of this year and the US in early November. And of note, emerging themes like ESG and AI are also set to emerge and to redefine priorities in the coming years. And in particular, the geopolitical aspects of AI are expected to take center stage. And this could potentially intensify the US-China dynamics and lead to a more fragmented global landscape as nations continue to grapple with these innovations and their regulatory challenges. Next, please. So against this backdrop, let us take a look at the growth outlook for the major economies globally and how we see and group the heterogeneous Asia-Pacific markets here. It is pretty evident that the growth profiles across the region are highly diverse. And going from left to right, we first have Japan, which has been on a low growth trajectory, and that is likely to continue in the coming years. But even then, the country will remain one of the top destinations for investors that is known to be deep and liquid, and with highly accretive financing options. Next, we have the other developed Asia-Pacific markets to the right, and they include Australia, Korea, and Singapore. They have fairly robust economic structures and well-developed frameworks, and that should put them quite well on track to outpace their US and European counterparts. And as for China, I think there's undeniable evidence of a structural shift occurring at the moment, but personally, I do not think that the country is in a systemic crisis. What holds greater significance is the government's strategic pivot to higher value-add industries, including renewables, tech, and life sciences. And these sectors are poised to become the primary drivers, fostering better quality growth over the long term, albeit at more sustainable levels. And on the flip side, other emerging economies like India and Southeast Asia are already evolving on a different tangent and are now one of the highest growth markets globally. They are already benefiting from China's efforts to weed out the lower value-add manufacturing and are also well positioned to continue from the ongoing China Plus One and reshoring efforts going forward. Next, please. Hence, I think the significance of Asia-Pacific extends not only to the global economy, but it also means quite a fair bit to investors as well. So on this slide, we can see the breakdown of the GDP growth contributions by regions and countries. And this clearly illustrates the substantial role played by the region over the past decade as represented by the various blue layers here. So in fact, Asia-Pacific accounted for more than 52% of global growth during this period. And looking ahead, the region's importance is set to remain intact. So from now to 2030, Asia-Pacific's share of global growth is set to stay above 50% as the momentum in the Western world tapers. And with China, India, and Southeast Asia collectively contributing half of the world's GDP growth during this period, it is undoubtedly a significant development. And this is expected to also benefit the developed economies such as Singapore and Australia. Next, please. And this brings us to the next slide on the global monetary policies and seeing how central banks have pivoted since mid-2022. This slide is a little busy, so I would like to bring our attention to three key viewpoints. Firstly, the monetary policies within Asia-Pacific are quite varied. This is indeed very different from the US and Europe, where there's a centralized management approach. Hence, this highly calibrated backdrop in Asia-Pacific would continue to result in three key realms, namely China, Japan, and the rest of the Asia-Pacific region. And that should stick for a while. Secondly, most central banks are now at the tail end of their hiking cycles, and they should stay the course until mid of this year. There is a strong possibility that select advanced economies in Asia-Pacific, such as Korea and Singapore, could be the first to move and very likely to be in sync with their US and European counterparts. Thirdly, we also believe that Japan will remain in focus as it continues to pivot from its ultra-loose monetary policy. The BOJ, or the Bank of Japan, finally scraped the complex yield curve control policy and also moved away from the negative interest rates yesterday, following the deemed successful Shunto, or what is the annual wage negotiations between the labor unions and conglomerates over the past week. So looking forward, we believe that the BOJ's policy stance is likely going to stay accommodative and to allow the zero interest rates to sit for a while through the rest of this year. We can then expect a marginal increase in early 2025 as the 2% inflation target comes more into view. Next, please. So moving to the FX trends here on this slide, I think it's pretty evident that the rate differentials and liquidity conditions have led to the outsized depreciation of major currencies against the US dollars between 2021 and 2023. Most developed markets, as you can see here, recorded steep declines over this period. The yen was down by a third, followed by the Korean won and Aussie dollar. But looking ahead, I think we can expect the narrowing of interest rate differentials to alleviate some of the pressure when the US Fed starts to pivot and loosen later this year. This could bring the yen back to the 120s and the Korean won up to the 1200 range by the end of 2025. And other developed market currencies such as the Aussie dollar and Sing dollars are also expected to see smaller uplifts, but in the 5% range over the same period. On the flip side, the euros and the Swiss francs are unlikely to appreciate much based on the projections for Oxford Economics. I think that is largely due to the prospect of swifter policy easing by the ECB as well as the Swiss National Bank. Hence, we believe that this current cycle could present an attractive entry point into Asia Pacific for these inter-regional investors. Next, please. So moving to the next couple of slides on the real estate market overview, let us take a look at the current market trends for key sectors in the region. The broad narrative hasn't really changed over the past year. The overall landscape is predominantly led by consolidation and flight to quality activities. That is in fact quite consistent with some of the current trends across Europe right now. So starting with offices on top, the general observation is while leasing activity has picked up, the expansionary demand is still lacking despite the return to office waves across major metro cities at the moment. This has contributed to a rise in vacancy and subdued rental trends in recent quarters. But even then, on a more positive note, overall vacancy rates remain well below those in the US, and they are also very comparable to or slightly lower than major European cities like London and Munich. So looking ahead, we anticipate that most markets to further stabilize in the coming quarters as corporates continue to push for more employees to return to the office. And we believe that the standouts will be largely in markets such as Seoul, Singapore, and Sydney. Moving to retail, the ongoing cyclical recovery is definitely progressing, though nothing really too exciting going on at the moment. But when this is viewed against the current macro backdrop, it can be considered rather positive. Vacancy has definitely improved and stabilizing at healthy pre-pandemic levels in the 2 to 7% range in most developed markets, and of course with very limited new supply in the pipeline. Retailers are gaining confidence and selectively expanding, but rental growth is still expected to be gradual in the coming years. And the key reason for that is retailers are still constantly adjusting their operating strategies to align with the fast-changing consumption patterns, and that may curtail some long-term space requirements. Next, please. And as for logistics, the robust rental growth rates observed since the pandemic is definitely easing, and this is expected to persist in the coming quarters. And the primary reason for that is there has been a slowdown in expansionary demand from major occupiers that includes the e-commerce operators and third-party logistics firms, as online retail growth continues to normalize across the region. The abundant pipeline brought about by accelerated investor interest in recent years has led to the current construction cycle in most of the markets we operate in. This should serve to limit any upside rental movements in the next couple of years, particularly in developed markets such as Greater Seoul and Greater Tokyo. But there is no doubt that occupier demand is still expected to stay robust and should keep pace with the enlarged pipeline, and it's largely underpinned by the fast-growing consumer base, and this is unlikely to change in the coming years. So moving to the realm of the living sector, the global residential market has undergone a significant shift in recent years. This is primarily driven by the increasing unattainability of home ownership for many, as soaring home prices outpace income growth in most of these markets. Hence, this has fueled a growing demand for rental properties in Asia Pacific, especially in the more mature markets of Japan, with Australia gaining more popularity in recent years. The appeal of the build-to-rent sector in the Asia Pacific region is definitely increasing, And that is driven by a myriad of circular and structural trends, such as heightened inward migration, as well as a demographic shift towards a younger population that prefers renting. There is also a shortage of institutional-grade rental properties in major metro cities, and the situation is exacerbated by stringent land use regulations, which are likely to continue constraining new constructions in these areas where the demand-supply imbalance is usually most pronounced. Next, please. So next, let us look at how cap rates have moved so far. I think the yield decompression cycle that commenced in early 2022 saw an accelerated trend for most parts of last year. But that being said, the upward pressure on yields appears to have alleviated in recent months, and this is largely attributed to some tapering of the restrictive monetary policies by several central banks in the region. So by sector, and starting with logistics on the right, there is no surprise that the sector experienced the strongest expansion pressure in this cycle, particularly in Sydney and Seoul. Cap rates in these markets rose between 100 and 130 basis points just over the last 18 months alone. I believe this is largely comparable or slightly below what some of the major European markets have experienced so far. So shifting our focus to the office on the left, there have been relatively modest expansions ranging from 30 to 85 bips so far. That being said, the magnitude of yield movements do vary quite a bit across asset grades, with non-grade A buildings experiencing way more pressure compared to the prime stock. And in contrast, the retail sector has only recorded marginal movements of between 10 to 30 basis points. And this stands in stark disparity to the core markets in Europe, where higher increments have been observed over the same time frame. So looking ahead, we hold the view that the decompression cycle is likely going to persist into late 2024. Yields are expected to stabilize at that point, possibly followed by potentially some slight compression from mid to late 2025. As such, the resulting repricing and refinancing pressure in some of these markets could offer intriguing opportunities over this period. Next, please. And I think we always believe that Asia Pacific can be a good diversification play for global investors. And with this in mind, we wrote a paper sometime last year to explore the potential benefits of diversity that Asia Pacific real estate can offer as an investment destination. I will be sharing a couple of key findings here today, and we'll be delighted to share the paper after this session. And in this paper, we examine the incremental total return per unit volatility for the various hypothetical US and Europe-centric real estate portfolios. And turning your attention to the two rightmost set of bar charts, our analysis indicates a consistent and notably substantial incremental value when Asia Pacific real estate is incorporated into both portfolios. So in essence, looking at hypothetical portfolio 3 highlighted by the dotted blue box as an example, by strategically adding 30% of Asia Pacific real estate into the Europe-centric portfolio, we observe a remarkable 46% increase in per unit return that rises from 0.56 to 0.8, so 0.59 to 0.86. And of course, I think while the results are encouraging, we do understand the theoretical nature of this research exercise and the data limitations for this analysis. We hope that this exercise can at least provide investors with some quantifiable insights into the potential portfolio diversification for global investors and what it can offer in the current climate. Thank you.
Good afternoon. Thanks for joining us today. I'm going to talk about Asia Pacific Value Add, which is a higher risk return strategy. Typically, we'll be targeting IRRs in excess of 15% over whole periods of 3 to 5 years. Over the next 2 slides, I would like to just briefly explain why we think this is a very good vintage, why 2024 and 2025 is likely to be a very good investing vintage for Asia Pacific Value Add. I guess the most pertinent question that a lot of investors are asking today is, when will the Fed cut interest rates, right? I think there was certain expectation that it might happen in March, but I think it's not going to happen in March now. It's likely to going to be perhaps June or maybe even later in the year. But from a value add perspective, the longer it takes for the Fed to cut interest rates, and obviously interest rate cuts to be effected in Asia Pacific, the longer the window of opportunity will be open if you have a value add perspective, right? So as Eugene has explained over the last couple of slides, capitalization rates have increased quite significantly across Asia Pacific over the last 2 years, right? And these higher capitalization rates are actually creating very attractive entry points for new investments with a value add lens. I think we also come to the realization, or I guess the current consensus is that higher for longer interest rate will kind of persist in the market over perhaps the next 2 to 3 years. But the reverse is also true in the sense that if inflation does come under control, there is potential for rate cuts to also lead to yield compression, as we move through the next couple of years within the Asia Pacific markets. I guess the second point that I want to make is that the markets across Asia Pacific are highly distinct, which is why we are emphasizing from an Asia Pacific value add perspective the importance of being very diversified from a sector selection perspective. There are a lot of growth sectors in the marketplace today that are driven by structural drivers relating to demographics, like, for example, the housing and healthcare sector, digitalization, which is obviously impacting the growth of data centers investments across Asia Pacific, and the diversification of supply chains, which is obviously having positive impact on logistics markets across Asia Pacific, and last and not least, decarbonization, which can also kind of see the reason why premium offices are in demand compared to offices that do not necessarily meet the ESG requirements. The third point I want to make is that development pipelines are actually under pressure across sectors. And this is largely due to the impact of higher interest rates plus banks tightening lending standards. This has resulted in a lot of future development that is not kind of meeting target returns. And as a result, these developments are not going ahead. And if this is true, and this holds true for the next couple of years, you might even see a situation where demand, new supply in the pipeline will be below historical levels, which will actually help boost rental growth over the medium to long term, and also help the acceleration or the recovery of property values. Next slide. The fourth point I want to make about why Asia Pacific value add is very attractive in this cycle is that this cycle is different. In the good old days, we could buy an asset, leverage it to pretty high levels of 65, 70%, kind of pay very low interest rates, and kind of make your returns when you see yield compression. But in this cycle, because we are not able to achieve that high loan quantum, and interest rates are obviously a lot higher, we have to derive our returns via active asset management. And the way we think about it is that every time we look at the property, we will be thinking how we can reposition the property, how we can refurbish the property, and decarbonization strategies are also very, very important in how we look at portfolio construction in this particular cycle. Again, despite the fact that interest rates are high, in terms of a value add strategy, it's still accretive when we look at kind of trying to look. Okay, beg your pardon. The higher cost of debt and lower leverage quantums in this particular cycle is still okay from a value add perspective because it's still accretive. It's the point that I was trying to make. Apologize. Next, finally, you see a lot of commentary in the marketplace. A lot of investors are predicting that 2024 is going to be a very interesting vintage. Investors are obviously eager to start buying again. We also observe a narrowing of bid-ask spreads in the market. But I guess the point that I'm trying to make is important to stay disciplined. It's very, very difficult to time the bottom and, kind of try not to kind of succumb to FOMO fears, right? Just stay disciplined and underwrite the opportunity in the most appropriate way, and this should potentially be a very good investment in this particular cycle. Next slide. Okay, this is quite a busy slide, but I just wanted to quickly kind of summarize some of the opportunities that we're seeing across Asia Pacific. And the way we kind of classify the opportunities is in three buckets: growth, tactical, and contrarian, right? So under the growth bucket, we obviously see offices in Singapore and Seoul as still very interesting sectors that we will be targeting if we kind of look at it from a value add perspective. There are a lot of opportunities in these markets that provide kind of repositioning, revert, and reversionary rent potential. So this is one sector that we're interested in. Logistics in Australia is quite well documented that vacancy rates are quite low across Australia, which is why we still have it as a key sector that we are looking at. And again, I think my colleague also made that point earlier. Living assets in Australia is also a key growth sector from our perspective. It's kind of supported by structural supply shortfall, very positive demographic growth that we're observing in Australia, and declining home affordability that is driving its citizens to rent. From a tactical perspective, we like offices in Sydney. Cap rates for offices in Australia have kind of increased to the 6.5 range compared to kind of pre-COVID lows of 4 to 4.5 cap. So these opportunities are very interesting from a tactical perspective. If we can identify opportunities with refurbishment and repositioning potential. Retail has obviously been an asset class that's not been very popular with investors over the past decade, driven in part by e-commerce, and obviously a lot of the capital that was targeting retail is targeting the logistics sector. But we are starting to see the re-emergence of retail, and I think we like dominant non-discretionary retail assets in Singapore and Australia. Logistics, again, has been a very popular sector. Japan is one key market. There is quite a bit of new supply that's expected to come on stream in Japan, but we see a lot of the existing stock in Japan as being quite old. So I think a lot of the new stock that's expected to come on the market is going to be very welcomed by the market. Similar trend that we're observing in South Korea. And I guess lastly, from a tactical perspective, we like hotels. COVID has obviously caused a lot of issues in terms of the hospitality asset class, but the recovery post-COVID has been extremely strong. And we like hotels in the key gateway cities of Japan, Australia, and Singapore. That's kind of poised to benefit from the increased emphasis on the quality of stay and the potential return in international travel from Chinese tourists. Lastly, contrarian. Contrarian is, kind of asset class that are, arguably not performing so well from a cyclical perspective, but this could potentially be where the deepest discounts can be found in terms of some of the opportunities that we look at. So one particular sector that we are looking at in terms of from a contrarian perspective is kind of grade B offices in Japan. Again, there is quite a bit of new supply that's expected to come on stream, in Japan, which is why we think that it could be a potential contrarian opportunity. And lastly, in terms of the final point I would like to make is cold storage in South Korea. That particular sector is starting to see quite a large oversupply situation. But there are deal flow in the market that we are kind of underwriting that you could potentially buy a cold storage asset, right, at 8 to 9% cap. And if you are prepared to kind of underwrite the downturn, with kind of 0 to even perhaps negative rental growth. But because of the attractive pricing that you are achieving on entry, you could potentially derive a pretty interesting return on exit. Thanks. That's all I have for my slides. Thank you.
Hi, good afternoon, everyone. My name is Kevin. I'm the fund manager for CapitaLand's flagship Pan-Asian open-end core plus fund. So just taking a step back, but if you look at this slide, and if you look at the real estate risk spectrum, what Jeremy has been talking about is on the value end, the higher end of the risk spectrum. My focus of my fund is the core plus spectrum, which sits in between core and value add. So if you were to focus at just a quick moment on traditional core strategies that we are seeing today, the traditional core strategy has become increasingly challenging to execute, especially as Jeremy mentioned in a higher for longer interest rate environment. Some may even view core strategies as riskier today, as thin or negative yield spreads leave very little or no margin for error. As such, what we are seeing is more investors looking to core plus strategies. So, as compared to Jeremy, which looked at a slightly higher target returns, for core plus, we're looking at a range of between 9 to 11%, which is perhaps slightly higher than what core plus, the traditional core strategy would offer. But I suppose then the question arises: what exactly is core plus? First of all, we believe that a core plus strategy should be driven, by a bottom-up approach, with each investment singled out for its core plus potential. And this is as opposed to blending traditional core and value-add investments to engineer a core plus portfolio return. So we look to each investment and underwrite each investment for its income and capital return contribution to the portfolio total return. For us, a core plus strategy revolves around buying, managing, and importantly, too, recycling well. Yeah. And by buying well, we look to acquire quality assets at attractive entry points, to curate a diversified portfolio of varying maturities to optimize total returns. So a core plus strategy to us embraces slightly higher but mitigated real estate risks to achieve higher risk-adjusted returns. And these include forward purchase arrangements with rental guarantees or taking on higher but calculated leasing risks. By managing well, we employ proactive manage to core strategy. So we acquire a core plus asset, we manage the core plus asset to core. That's what I mean by manage to core, and in doing so, drive performance. And these include lease ups, limited asset enhancement initiatives that are non-disruptive to the operations of the asset. The recycling well is a critical part of our equation, right? It's really about keeping the exit in mind when managing an investment through its life cycle. And the reason why you want to do this is because core plus assets will eventually mature and become core, and you'll want to be able to recycle the asset to generate higher returns. So what we do is that we conduct regular wholesale analyses. We are disciplined about we will be disciplined about exit strategies. And then what we hope to achieve is to recycle capital into newer assets when the opportunities arise. So moving on to the next slide, underpinning all this, when we look at in our investments, an investment framework is really required to ensure that investments are sustainable and can stand the test of time. The reason for this is because, as a core plus fund, we would hold our assets for longer. We are a perpetual fund, so our hold periods could be up to 7 years even. And so you want your assets to be able to stand the test of time and to meet increasingly high standards of sustainability. So for a core plus fund, investment decisions are based on key themes. Firstly, ESG is an imperative, and our investments need to exhibit sustainable characteristics to mitigate the risk of obsolescence and also decarbonize over time. I think we are all aware that the advance of e-commerce is inevitable, and its impact on supply chains, distribution channels, and manufacturing trends need to be considered carefully. Structural shifts in occupier demand and government initiatives such as major infrastructure schemes will drive also regionalization trends and the emergence of new submarkets. And these are locations where we want to be. And of course, in the office sector, office assets must be positioned to embrace the digital economy and evolving workspace arrangements. So these are key, what we call key themes, guide us to make sure that the assets we acquire can stand the test of time. Moving on to the next slide, now the question is about where do we see Core Plus opportunities? Now, as Eugene spoke earlier on, he mentioned about the diverse nature of APAC, both on the macroeconomic front and also on its real estate landscape. And we believe that a Core Plus strategy is very well suited to capitalize on this diversity. So where do we see Core Plus opportunities? First of all, we look to develop APAC markets. China and Hong Kong are not on our radar given the geopolitical risks, right? So we're very much focused on the developed markets of APAC, namely Singapore, Japan, Australia, and South Korea. If you look at the top half of the chart among defensive assets, we see retail as interesting, as it's really been established that non-discretionary retail and experiential luxury retail are very clearly established, very resilient segments. In Singapore, suburban non-discretionary retail is especially attractive. The government's urban planning policies limit new supply, while retail mall footfalls remain very robust in a country where transport infrastructure is very good, and shopping really is a national pastime. The other sector that we like is the Japanese rental housing market, which remains on a growth trajectory fueled by ongoing net migration to larger cities, an increasing number of small households, and the growing unaffordability of home ownership. And a more recent trend that we're seeing is the resumption of rental growth, driven by inflation and nascent wage growth following decades of stagnation. So capital values of rental housing in key cities like Tokyo and Osaka continue to rise, with cap rates in these cities tightening, despite the rise in borrowing costs in Japan. Within the pro-cyclical space, we see the Korean logistics sector at a pivot point. The sector has become more institutionalized in the last decade, driven by a combination of factors, including economic growth, e-commerce expansion, manufacturing strength, and very, very supportive government policies. So we saw peak new supply in 2023. So some people may say, do you really want to invest in a market that has got peak supply, where vacancy rates are relatively higher than historically? But however, what we're also seeing, right, is rising construction costs and borrowing costs, along with limited availability of construction financing. And what this has led to is that expectation that new supply will reduce significantly from 2023 levels. And we're looking at 30% in 2024 and a further 70% in 2025. And these disruptions present a window of opportunity to invest ahead of the curve. As Jeremy pointed out, the Australian logistics sector is also getting interesting. Australia enjoys one of the most robust population growth rates among developed nations. Its e-commerce penetration rate trails behind markets like the US, UK, and Singapore. And Australia, on the other hand, faces one of the most constricted logistics landscapes in APAC, with key cities like Sydney, Melbourne, and Brisbane facing vacancy rates of less than 1%. On the other hand, projected new supply between the second half of 2023, 2024, and 2025 account for only just 4% of total stock, which is unlikely to alleviate the situation by very much in the coming year. So it's certainly an interesting market to watch out for. Lastly, the sector that we will keep an eye on and just keep in view is the Australian office sector. On the one hand, the sector continues to soften in view of slower return to office, the relatively high vacancy rates, and weak investment sentiments and high interest rates that we are seeing in Australia today. On the other hand, similar to many markets in the world, high construction costs and financing costs are together with a steadily growing population and the prospect of declining interest rates on the horizon provide positive tailwinds in the midterm. So it provides it offers a market to keep in view. We think that there's still room for decompression of cap rates in Australia office, but certainly I think in time to come, opportunities will present themselves. So at this point, I'll end my section here. Happy to take on any further questions later on. And I'll pass this over to Arjun for his section. Thank you.
Good afternoon, ladies and gentlemen, and thank you for your precious time today. I would like to share with you some exciting developments in the world of private credit as it pertains to the region here in APAC. I guess I just have 2 slides, and my view is that these 2 slides should be able to tell you the whole story. If you look at private credit in Europe, and I'm sure you've had experience over the last 10 years, and also the US, we can see that there has been a disintermediation of the financial system post the financial crisis and the European banking crisis stress in 2012. In Asia, on the other hand, the banking sector had been very robust, and we've had a situation where private credit is still a very small part of the overall credit markets. In Asia, it's 20% compared to Europe, where it's as high as 54%. If you look at the Asian economy, on the other hand, in terms of the GDP contributions, and my colleagues on the research side and both on the core fund side and value add side mentioned, Asia is one of the fastest growing regions in the world, and the GDP contributions are at 46% of the global GDP. But private credit itself in Asia, as it pertains to a share of private credit globally, is just 6%. Also in Asia, in terms of private credit, the direct lending side of the business, which is traditionally been the largest side of the private credit growth in both Europe and US, has been pretty nascent. So the question that I get asked by investors is, why is that so? And my simple answer is that Asian regulators have been much slower compared to the European regulators and in the US in terms of implementing Basel III regulations. And also, there has been a reluctance in terms of the risk management discipline. But that is all coming to a big change in Asia, starting with countries like Australia. We've had massive changes in Korea, both in the insurance capital side and also on the banking side. And then there is tightening that is happening in other parts, including India. So if you just move to the next slide, in Asia, when we think of private credit, we think of capital preservation. And the business really focuses on producing product which is a proxy to fixed income, where our investors can enjoy predictable returns, with a very high cash on cash return basis. And the products are generally short durations, anywhere from 2 to 3 years. Overall, the markets where we see the maximum opportunities are the developed markets of Australia, South Korea, and then opportunistically, we see products in our home base in Singapore and also Japan. India is a market which is fundamentally growing at a very large scale. And as we all can believe that credit is actually the lubricant that makes an economy grow. So in India, the demand for credit is really coming from growth credit or growth capital, which the banking sector cannot fulfill. So our convection strategies in Asia relates to performing credit, first mortgage lending, high cash on cash in geographies which have got very proven legal systems. Our borrowers are all institutional investment grade borrowers, large corporates, local champions, global investors investing in regions. And we are able, in a unique position with CapitaLand having presence on the ground in terms of our country presence, have the ability to originate products on a bilateral basis and create portfolios that match the risk return of our investor base. Maybe just as a final point, in Asia, the private credit market is poised for a massive growth because of the big gap in the demand for financing. As some of my colleagues have just mentioned, build to core doesn't have sufficient financing. Value add strategies also requires innovative financing. So in terms of the opportunity side, we can see on the slides that the gaps currently on the banking institutional side is running into tens of billions of dollars. And from our perspective here in CapitaLand, our house view and my own view as a product lead is our phase of growth on private credit is almost on the cusp or at the, passing the cusp point where Europe was in 2012. So maybe just as the final point, when you have had experience in private credit in Europe, one of the questions would be, Asia is a very large, region, and how do you cover such a region? We have localization of a business in each of these countries with specialized credit teams overlaying our country infrastructures. And I believe localization separates us from other managers because we manage people's money, but we also manage borrower relationship. So I'm happy to take questions, at the end of the session. And I would encourage everyone to do a little bit more research because I do believe private credit in Asia has an outstanding opportunity in the next coming few years. Thank you very much.
Hello. Hi. Good day. Guten Tag. I will start my session. I look after the private equity lodging funds, and particularly, if you look at the lodging or what many people would define as living, you can see on this slide, actually the spectrum is pretty wide. Now, you have heard a lot from this discussion earlier on from our research team. I think you hear about residential, the demographics story. But what I want to show you on this slide is really how we differentiate ourselves between the pure play residential or the build to rent that is widely known in Europe on one end of the spectrum and hotel on the other end. Now, if you look at this slide really, then I think the main difference lies in where we put ourselves in service residence and co-living being in the middle, by both being able to behave like a residential or hotel, but it is an intentional strategy what we want to be. Why this is so, right? Because in build to rent, as you would know, typically these are leased out for 1 year or even sometimes longer, 2 years. Now, what do you miss out when you have a very long lease tenure? Obviously, your rental is very stable, but you also lose the ability to capture rising rentals because you simply can't. You have to wait for the tenancy to expire. On the other hand, on the other end of the spectrum, if you have hotel where it's very short duration, it can be very volatile, right? We just came out of pandemic and COVID, where you have seen hotels being shut. When there is no international arrivals, there is no business, means there's no business. At best, you have a hotel that runs on single-digit occupancy. Now, where we sit in our service residence co-living strategy, by intentionally putting ourselves in the middle, what we call a hybrid product, we have the ability to choose to have more longer stays in situations where market is more stressed or down or pandemic. Then you are actually very stable and you behave exactly the same like what a multifamily would offer you. But unlike a multifamily, in better times, in improving environment, like now where demand is coming back, a lot of revenge travelers, business, can't wait to meet their counterparts, their customers, their clients, where face-to-face is important. Then you see a lot of these rising rates, whether it is daily rate, short-term stay rate, medium stay rate, the longer stay rates for the corporate expatriates. As a multifamily, you simply can't capture those business until your lease expires. But being in service residence, we can choose to pivot to have some portion of the inventory to capture some of these higher paying customers and enjoy that rental premium. Now, by having this ability to pivot shorter or pivot longer, as you see, as your outlook, whether it is improving outlook or more depressing outlook, then you have the benefit of both worlds. You have the best of both worlds. You have the rent resiliency like a multifamily, and you have the rental premium that you can enjoy, right? Now, next, if we look at the cost structure, it is also very lean because it pretty much functions like an apartment, but with some amenities and furnishing thrown in, and that is where you get a rental premium. Now, you don't need bells and whistles and multiple restaurants, multiple ballrooms, meeting rooms, like a typical hotel. That saves a lot because these are expensive capex, huge floor area that, would have been, usually underutilized. Now, then what we then do is basically convert this into rooms, which tends to have more predictability, consistency in the business, and also, more importantly, a higher margin that translates down to the bottom line for an investor in this space. I think the other important differentiation is the way this sector is being run. Typically, your staffing ratio is very lean. Now, unlike hotel, which tends to have 0.5 staff to one room, or 1-to-1, or sometimes if you go to higher-end hotels or resorts, even higher than 1, what we always target to do in many of the service residence investments that we make is a staff to room ratio of 0.2, right? So that is very lean, and naturally all this lower operating expense flows down to a higher bottom line, and that gives a much higher return on investment. Next slide, please. Now, this slide really summarizes what I spoke about earlier, the resilient business model with the ability to pivot. Then you have the best of both worlds because you have stability and you have got higher rental paying customers, lower upfront investment costs, lower operating expenses, thus giving to a higher operating profit margin and better return on investment. Now, our investment strategy is to basically focus on building a portfolio of modern and sustainable service residences. Some of the investments that we make, it may be older building that may be less green. I think bringing them to a path to green is always very important. It is our commitment to sustainability and every investment that we do. Obviously, we want to focus, we want to be very selective in strategic locations. We only choose key gateway cities, whether these are in Asia or in Europe, Why these locations? Because these are places that are fundamentally and long-term very sound, attracts a lot of business. The government will be business friendly. And these are places where we can have a duality of demand, not just relying on a single demand alone, business or leisure. Now, in many of the locations, the micro locations that we choose in the cities, which are very prime, then we don't want to basically just capture one single source of demand. As we see, it can come and go pretty fast and a lot of times unexpectedly. Now, having that duality of demand, whereby if you have got higher paying customer, whether a business traveler that comes in for 3 nights, or an IT, Oracle, SAP consultant or management consultant who may come in for 3 weeks to 3 months, these are definitely higher paying customer than renting out for 1 year. I think that is where the rental premium can be benefited by investors in this space, which we like to call this as multifamily or BTR plus. Leveraging the Ascott platform is very important, and I'll come to that to explain to you. This is basically our wholly owned sister company that is very strong in operating platform, 40 years of history, spread over 226 cities and over 40 over countries. And how that platform basically generates a lot of operational advantage, higher bottom line, through their scale and the distribution network that they have and the corporate clientele that they have. Now, our strategy is really value add, but unlike Jeremy earlier that you hear from them, it is value add in diversified sector. We are very targeted. We are value add in living sector, in service residence and co-living. What are some of the things that we have done before and added value? We have looked at converting underperforming buildings, underutilized buildings whose area footage is not as efficient, which we then go in to do the heavy lifting, value add work to repurpose, reconfigure, change the entire layout. And then we have done that, to bring a hotel to a service apartment, hotel to co-living, offices, to co-living, even residential apartment for rent building, which we feel that the area is just overly specified, is too large, not very efficient. And then we convert that into a leaner room configuration, bring in the clientele and the distribution network and rent it out, as a service apartment, and clearly has exited from those sort of strategies with gross returns, IRR of 21%, net of 19.7%. So these are real value add work that the team has done. And then moving on, please, to the next slide, where I wanted to just give you a very quick glimpse. Next slide, please. Yeah, so this is a profile of Ascott and its global presence, spread all around the world largest service residence owner operator. And this scale is really important because it translates to all the things that I spoke about earlier, through their distribution strength, through their corporate clientele, through their operational advantage, their scale, that brings about economies and savings to the investments that we make. Now, more importantly, the strength of Ascott is actually independently verified, right? Because over 80% of the portfolio that you see here belong to third-party asset owners, right? I think that means a lot. The fact that these third-party independent asset owners continue to want to engage Ascott to manage their buildings, to manage their service apartments, is a really true independent testimony of how strong they are, which is why as an investment thesis, we want to continue to have this combination and work with Ascott, the combination of CapitaLand and Ascott, to do value add work in this space. Moving on to the next slide is a summary of what I spoke about on all the Ascott advantages. I won't go through this in detail, but you can read it at your own leisure time. What I really want to touch on is really on the next page, which is examples of some of the value add that we have done. Right? If you move on to the next slide, this is the example that I spoke about.
Hokit, you're on mute.
I think you turned to mute, Hokit.
Yeah, sorry, Pauline.
Sorry.
Slide 32, please. No, the one before. One more. Thank you. Yeah. So this is the example that I wanted to talk about. It's a real example that the team has done. We went in, look at the residential building for rent, find that it is overspec, did the heavy lifting to reconfigure the space, added in additional inventory, stabilized the building, and eventually exited, right? When we exited, the IRR was a net 19.7%. And there are many more examples. And the next one is a very recent example that we have just completed, the AEI. AEI stands for Asset Enhancement Initiative, and we do a lot of all this heavy lifting work. We had an opportunity to look at this building in the middle of COVID. It was intentionally built as a hotel, but of course, COVID affected everybody else, and they were shut, so they never really opened. When we look at this building and off-market opportunity, there were the green floors that were built, and the blue floors they have actually decided to demolish, because obviously hotel during COVID wasn't exactly the wisest thing to do. And then they had wanted to consider, turning it into office. And finally, then they were doing halfway on plans to make it into a capsule hotel, hopefully to bring in more headcounts and more guests into the property. But all that did not materialize. And when we acquired the building, our plans was very straightforward, right? So we look at the space, we look at the area, we look at the location. Arguably, this is in a very prime location in Ginza. And if you are familiar with Ginza in Tokyo, this is the location whereby there are a lot of great ass office buildings, big floor plates with all these international Japanese clients, that are in this building. Now, one would then suggest that in such a prime location where land cost is very high, you would put the highest end product in order to maximize your revenue. But when we look at it, we felt that that would be not so appropriate, because it is also very saturated in that price point. And we ask ourselves, do we then, are we able to find an alternative customer with a different price point? And that also saves us a lot of effort in trying to do breaking down the walls in order to change it into a bigger room product. But that would otherwise add a lot of execution risk as well. So we did not do all that. And what we have done then was to bring in our co-living product, intentionally targeting more millennial customers who do not mind the smaller rooms. So saves us a lot of effort from reconfiguring the rooms, which will be expensive, and then playing in a space where it is saturated with a lot of higher price points, alternative accommodation in that location. Now, by doing so, we introduced the co-living product. The square meter in the rooms are small, but bringing in co-living amenities that allow us to charge a higher price point for these customers, who then find that they are in a space where they are no longer affected by the small room space, but are then thrilled and excited that they have all these co-living amenities there, and that they can sit around, see and be seen, mingle with people, and enjoying their space. You can even co-work there. If you move to the next slide, I'm going to show you some pictures of before and after very quickly. Now you see the before and after of how we have added more life to the space, and then put in rooms that have got higher utility, right? From smoking room to server room. And you move to the next page, please, on the second floor, which was originally just a hotel lobby reception. But you see that what we have done was to use the same space without taking up additional floor area, which is expensive, introduce gym, introduce co-working space, introduce more private cubicles that you can sit there and work. You have to have a choice of sitting in the open and work, as well as the next page, please. And introducing a washer dryer in the space. Now then, completely change from a very hotel mindset property into something where you can then stay longer, live there, and mingle around with people, right? And finally, the next slide are some examples of what are the changes that we have done in the room. bringing in that co-living approach, targeting those co-living millennial guests. The rooms remain very small, so we don't have to go through very risky project execution by knocking down walls, which will be expensive and time consuming. And next slide, please. More examples of rooms that we have done. This is the empty floor that I spoke about, which we then introduced these co-living rooms into this area. Next slide, please. And this is the last slide, I believe. Yep, of what we have done in this space. Now, this property has since opened for just 3 months right now. And what we see in this property and in the sort of performance that it has achieved so far, and hopefully that stays away, it has surpassed our underwriting and is looking good and pretty in terms of its business and its performance. So I hope that gives you a flavor of some of the value add work that we do in this particular space, intentionally looking for these distressed, underutilized buildings where we can convert, whether it's office or retail or residential, or even from another hotel or service apartment into what we do. Thank you.
Thank you a lot to all the speakers for your excellent presentations, the outstanding ideas, as well as the targeting cases and examples you presented. We received plenty of questions, and some of the questions we have already answered. Others are very, very interesting for everyone as well. And probably one of the big questions we have, especially as well as you as well, is the topic of different currency hedging. We have all the different markets in Asia with all different currencies, and probably if we go through the different presentations, we recognize the outstanding and really big value of real estate assets within the APAC region. And so probably one question for you, Simon, could be, how do you deal with all the hedging costs? How do you deal with all the currencies? And what would be the solution for you on the side of CapitaLand?
Thank you. That's probably the most difficult question of all in terms of talking about foreign exchange, particularly in this market. If you look over the last few years, obviously this US dollar has been very strong. The Singapore dollar actually has held up probably the best throughout the region. But I think the standout currency at the moment that's most topical is the Japanese yen. And of course, yesterday there was the decision by the Bank of Japan to start the movement to possibly increase interest rates. And I think in that regard, it might be appropriate for me to pass over to Eugene to provide his kind of research kind of perspective on that and what that might mean for real estate values and rents.
Eugene.
Yes, I think, thanks, Michael. I think the news is still pretty fresh, but I think this is probably expected from a market standpoint. I think it's probably homecoming for Japan, given that they have been in a very low interest rate environment since the mid-90s, and they have been at a zero interest rate since 2010 before going to negative interest rates in 2016. So I think from a longer term perspective, we do think that the Japan market is going to be vulnerable to any potential interest rate spikes, and I think that is one key thing that the BOJ might have to address the market at least, and definitely there will be quite a fair bit of knock-on effects on the real estate markets. I think apart from the interest rates impact on the potential risk-free rates, as well as the yield spreads with the cap rates for real estate. We also noted that the BOJ is going to stop the chases of the ETFs and particularly JVs. So I think there could be some potential knock-on effect on core stabilized kind of assets due to diminishing key funding source. And we could potentially see some revaluation and repricing of JVs. But as I alluded to earlier, I think the BOJ will be highly calibrated in terms of the interest rate movements, and I think what this also means is that this might be able to offer some opportunities both from the equity and the credit side of things because the funding source from one of the largest capital base is likely going to be reduced in the coming years.
Thank you, Jujin, for your answer. And there were plenty of questions for you for the Bank of Japan's decisions, and we will see wherever it will lead us. But I think it's a very targeting answer, and we will see what will happen the next year. And also about the time lag. So how long does it take to influence the market? So very, very interesting questions. Another question we have for you essentially is the topic of diversification. You pointed out very well the idea of diversification, and that's especially what Swiss, German, and Austrian investors are mainly looking for. I mean, anyway, you have astonishing returns, but diversification is nevertheless one of the most important topics for us as well. And you showed us one topic of the MSCI APAC, total returns with no correlation with equities, real estate equities, and REITs in the same region. Do you have an idea, or do you have do you know why we have such a low or especially no correlation?
Yeah, I think it's instead of me providing a granular answer to that, I guess I would say, if you look at Asia Pacific as a whole, these are very highly distinct markets, and not only from the real estate side of things in terms of the city sector kind of dynamics, but there are also additional layers that includes very different kind of interest rate policies, and the FX considerations that you mentioned earlier as well. And when you look at, say, you compare the MSCI APAC real estate returns index with, say, the REITs and real estate equities, and when we look at from that perspective, we also need to take into account that some of the listed REITs and real estate equities listed in the Asia Pacific geographies, their portfolios and their exposures can include both intra and inter-regional, right? And that adds in another layer of variable that should also contribute to the lower correlation. And that aside, we also have the lag kind of variations between the public and the private markets, as we all know. And I think, and that again is across a very, very distinct kind of geographies across the region, and that could be another factor.
Excellent. Thank you so much for your answer. We have a couple of other questions for the other speakers. So one is for the core plus investing. So I like to hand over to Kevin first of all, and then we go to the opportunistic side as well. Astonishing returns, I would say 9 to 12% for your flagship product, which is core plus. So
You're targeting, sorry, to correct you, 9 to 11. 9 to 11.
9 to 11. Sorry, 9 to 11. So sorry, 9 to 11. I misunderstood. Yeah. So congratulations, first of all, which is a lot for our perspective. So we have two questions essentially for you. You mentioned Japanese housing. I think we'll see how the Bank of Japan's decision will influence the housing market in Japan. I think Jujin answered this already. We have one question for you for the retail part. So there are a couple of questions for your retail side, especially for the AIE investments for the retail. Can you just give us more information of what is your strategy for the retail topic?
Just to clarify, AEI stands for Asset Enhancement Initiative. So these are essentially upgrading or repositioning initiatives to improve revenue generating capacity from an asset. Yeah. So that means, for example, maybe chopping up very large spaces into smaller units and renting the smaller units at higher rates of rent per square foot to generate higher income. So going back, so the question that you asked was about what sort of what initiatives are we looking at, right? So how we look at an asset is that when we consider an investment in a retail asset, aside from just the usual typical core return, which is generating steady rental income from the asset, we also look beyond the asset attributes whether there are means to generate an alpha from the asset. So if it's an older asset, we look at, I mentioned, opportunities to do some asset conversions, asset enhancements. We look at opportunities to drive footfall into the mall. And by driving footfalls into the mall, you end up attracting tenants who are willing to pay more rent because then they can generate higher revenues. We also look at opportunities to improve the efficiency of a mall, and that could be energy efficiency, water usage efficiency, and so on and so forth. And that would then drive the operating performance of the asset. The overall objective is to drive increased operating income, and that over time would translate to higher capital values.
Excellent. Thank you a lot. I think you clearly have a very interesting product, and we will see, of course, we are looking forward to the further increase in value and the further optimization potential. Very, very interesting strategies from our side. Jeremy, value add is always good if it works. You have plenty of topics that are affecting your projects. You mentioned ESG, you mentioned all the construction costs. So how do you do your risk management for all the topic of the value add part? Because we're always a little bit afraid value add is a little bit probably for the more experienced people. So what would be your recommendation for the investors, and how do you do the risk management?
Thanks for the question. I guess risk management kind of lies in two areas. Due diligence is obviously a very important factor. Your underwriting before you go into the deal, that's very important. You need to make sure that you have accounted for everything that you can foresee, and to a certain extent, you need to have some buffer in your numbers to account for things that you may not foresee. The second point that's pretty important to make is that risk management is essentially the day-to-day kind of asset management that we bring to the table. And I think that one of the key strengths that CapitaLand kind of brings to the table is our strong asset management operating experience, the fact that we have boots on the ground. So we are typically not outsourcing a lot of the day-to-day asset management. We kind of retain it in-house. So I think that for me, in terms of trying to answer the question, in terms of risk management, is obviously, again, the underwriting before we enter the deal, and obviously the day-to-day management, the fact that we have boots on the ground, the fact that we do our asset management ourselves.
Excellent. So foot on the ground, you know the market, you're connected to the stakeholders, and so you just received the follow-up questions. How do you incorporate infrastructure developments like subway system? What do you have an eye on further subway and train developments when doing your value add developments?
I think that is a very important consideration. Again, I kind of have to go back to the point I was trying to make earlier in terms of underwriting the deal. And there are certain situations when we underwrite the deal where we believe that that location will become more prominent, which is usually driven by future infrastructure developments that may take place. And I think the one market in Asia Pacific, perhaps there are a lot more markets, but the one market where infrastructure is very prominent in terms of how we think about our underwriting is a market like Australia, where there are a lot of future infrastructure developments in the various cities like Sydney, Brisbane, because of the Olympics. So hopefully I answered the question the right way. Location is obviously a very important factor when it comes to underwriting real estate, and infrastructure developments adds to the attractiveness of the location. Is the way I'll answer. Yeah.
Excellent. I think you answered it perfectly well, as well as Eugene. Thank you a lot for answering all the other macroeconomics questions at the same time. So we have a couple of questions left for the last two speakers. I mean, okay, you're really targeted and you're really in one of the most attractive topics for European investors, or the topic of alternative residential, if I may say so, and you're active in Europe. You're in Europe at the moment. you told me, and we are very keen as well as on all the topic of alternative residential. And we have a couple of questions for this point because I think there's plenty of potential on this. The first one is probably more on the overall side. If you have a look at the APAC area, do you see which areas or which, I mean, it's always difficult. I know we're looking at cities and there are plenty of influences on this. But if you can give us a broad overview, which markets, which cities and countries, regions would you evaluate as the most important and most targeting for the investments? In the sense
Yeah,
of
thank you,
investments
Michael.
and returns.
Thank you, Professor Michael, for the question. Maybe like a couple of locations, we particularly these developed gateway cities in developed countries, places like Tokyo, Osaka, Singapore, Sydney, Melbourne, Seoul. Right? Why these locations? You might ask. I mean, essentially, these are places where they are long-term, very sound business and investment fundamentals. Governments, irrespective of who comes into power, remains very pro-business and has been tested over time consistently, always remain very pro-business, whether whichever is the ruling party. And you can see over the years, the track record is there. The countries continue to attract various MNCs, lots of growth business-wise, to open up offices, regional offices, open up more manufacturing facilities, plants in these locations. Essentially, we are in the business of serving the end user demand. So we follow this travel pattern, this demand where such companies would go and basically position ourselves there. Now, our Fund 2, which just had its first closing, had invested in property in Singapore and property in Japan, doing the same thing. Examples of those value add book that I spoke about.
Okay. Elderly housing is a topic for you as well? Sorry, elderly housing. So, I mean, you have different brands, you have different foci, of course, but the area of elderly housing is an important topic for you as well, or you're more focusing on different target groups?
I mean, for this, we have different products, but at the moment, we are still studying the elderly housing market. As the operator, we have elderly housing product they need for third-party asset owners. Now, it is an increasingly important topic that we are tracking very closely because of the aging population around the world. But having said that, it's also important to go down into the details, because if you look at the elderly housing spectrum, it is actually a very wide spectrum, right? From one end of the spectrum is independence in the living, and then you move into care, you move into memory, you move into services and places that requires lots of medical support for elderly patients. Now, in different jurisdictions that you operate in these different countries, it comes with very different regulation around it and different licensing and planning. And on top of that, also hard ethical issues that you could deal with. If you have got an elderly patient who is ill and cannot pay the bill, then what do you do? Now, in different countries, I think we have got different ways of responding to this and how you can treat and these are our patients. Yeah, so I think there's a lot of, on top of medical regulation, regulatory, there are also ethical issues to deal with. And country to country vary significantly in terms of all these regulations and processes. So it's a market that we are excited about, we are studying. And on the operator side, we are treading in a very careful manner, wanting to understand that, but it's a service that we definitely have the capability to provide as what Ascot operator is ready to do.
Mm-hmm. We received another couple of questions for you. So also the topic is you showed us a beautiful map with targeting countries. So I know you're primarily active in Asia, APAC. Any plans to come to Europe, or what is your for further investments in Europe?
Yeah, in fact, we already are for us, we have been in Europe for the last 20 over years, and then have been investing initially through our balance sheet. And of late, our Fund 1 has invested in various locations in Europe. That includes London, Paris, Amsterdam, even a couple of the German cities that we have operations, have bought assets in and subsequently sold them to our REIT, right? So there are places like Frankfurt, Munich, Berlin, and Hamburg. Now, our Fund 1 has invested same value-add strategy in London, Paris, and Amsterdam. The most recent one, has just opened in Amsterdam. Again, another underperforming stress hotel that we bought during COVID. I think these are exciting times that we can do a lot more of such things. In fact, we expect a lot more of this coming up. I think banks are definitely getting less patient. There will be a lot of equity top-up. There will be no more covenants waivers. I think over the next 12 to 24 months, we expect to see a lot more of such opportunities. We also see many of these buildings like hotels, which are ripe for conversion because they have not been spending in the capex over the last very difficult 2.5, 3 years of COVID. And these are now getting obsolete and less relevant to customers. And it's ripe for picking, where you can go in there, do it in a very optimal way, add value, and then stabilize it to a higher level and deliver the alpha to our investors.
Okay. One follow-up question. Sorry for targeting so much on your topic, but it's we have really plenty of questions for you. Means investing in Europe and offering services, so it includes both, right?
Yeah, so there are two parts to that. The offering the services is what really Ascott will do, no different from how they treat us or another third-party asset operator. Now, in what we do in the private equity side, we are investing in real estate. In service residence and co-living, I mentioned this earlier. I think we are working with the best-in-class operator out there, which is Ascott. Now, we would want to engage them, but it is really arm's length third-party management contract. Yeah, they treat us the same as any of the other 80% owners.
Excellent. I will forward Ho-Kit's email details in the follow-up email. And for all topics of cooperation and for all topics of investments, please ask him directly and he will be happy to answer all your questions. So we try to make it short because we're running out of time, because there's one last question for Arjun. Thank you so much for elaborating on private credit, which is clearly a very interesting and good possibility to obtain attraction and which is good for investments. Could you elaborate a little bit more on the risk profile and how you plan, because private credits are a huge bucket for us at least. So can you elaborate a little bit more on the risk profile and how you manage all your private credits? Because in theory, it always sounds very easy, but in reality, it's not that easy.
That's right. So our simple, answer to this question is that we are actually a bank-like lender, but we are using our real estate expertise to actually manage the risk rather than outsourcing it to appraisal companies and quantity surveyors. Our lending strategy is really focused on providing capital solutions to borrowers to enable them to complete their strategy and then refinance with the main banks. And therefore, our lending is not dependent upon repayments through asset sales or market risk. They're really either built to core strategy financings or value add, where once the sponsor has done its value add, there's a value uptick and the main banks can come and actually finance it. And our LTVs, and I mentioned previously in our discussions that our lending is all mostly first mortgage. So we are a first mortgage lender in prime gateway cities, and our LTVs and our going in ratios are such that they're within the bank parameters. But using our real estate expertise to vet the business plan of our sponsors, their leasing plan, their construction plan is where we bring that extra alpha in our risk management. I mean, we can talk a little bit more about it if there are additional questions, but we are essentially underwriting all our loans to zero default. I mean, obviously, a zero loss is already assumed in this.
Thank you so much. I think there are plenty of more topics to be discussed. APAC offers plenty of possibilities for investments. We are very pleased that we could discover together with you all the different investment possibilities, the investment styles, also for covering all what is important for the side or from the side of investors, also new projects, new typologies like service apartments. We went into core plus investments, into value add investments, and finally also into private credit. So I think we have done the whole bouquet, what we call, so the whole bouquet of flowers we like to offer you. And also thank you a lot, Eugene, for all your macroeconomic and research activities. Hereby, unfortunately, we are running out of time. We have the academic quarter, so it's 50 minutes more than it was planned. Thank you so much for joining our webinar, for being here. Hereby, again, thank you a lot, Simon, for your introduction, for your welcome words, as well as showing us the whole universe. Afterwards, thank you a lot, Eugene, for giving us all the macroeconomic and research perspective, followed by Jeremy for all your value add products. Very interesting. We know you have your risk management on the table, knowing what you were doing. So plenty of possibilities for investments in such a huge market and such an upcoming expanding market. Furthermore, thank you a lot, Kevin, for all your insights for your from the flagship, I would say, product, Core Plus investing. Very interesting. If you have any questions for those who are from the first time Asian investments, Kevin will be very happy to answer all your questions, and you will receive his email on Friday as well. Arjun, thank you a lot for giving us the insight on private credit. Very new market, very attractive market. There's plenty of potential in the private credit and credit market. We will see wherever it will develop. I will also forward you email addresses like all the others. So if you have any questions for private credit, private debt, which is really an upcoming topic because it has a different allocation to the quota, so feel free to get in contact, and we are happy to listen to you for your answers. Finally, thank you a lot to kids who already left for the next meeting, for giving us the insights for all the topic of what I would call service apartment, alternative residential, which is one of the big topics here as well. And I think there's plenty of possibilities in that area. And finally, I like to thank the person in behind. So Pauline, thank you a lot for joining us, for organizing all this webinar. Thank you so much, Pauline, for the support. And so I will leave you for your afternoon, or for you as well as for your dinner, hopefully. Thank you a lot. And in case there are any questions, please feel free to contact the speakers, directly. Thank you a lot, CapitaLand, for your support for the webinar and for making everything possible. Thank you so much for everything.
You're welcome.
Thank you very much, Michael.
Thank you.
Appreciate it.
Thank you.
Thank you. Take care.
Thanks everybody for joining. Bye-bye.
Bye-bye.